This is a dollar pressure open, and the market is trying to pretend it's just noise, so you miss what it forces next. Because when the dollar index softens into the open, it's not a vibe shift, it's a pricing rule change that ripples through everything you care about. Metals, commodities, EM, tech, credit, even the way the first hour trades. And today has the exact kind of setup where a small DXY move can suddenly get loud. The cash market is reopening after a holiday pause, Davos is kicking off, and the tape is already being whipped around by fresh tariff rhetoric aimed at a cluster of European countries tied to a Greenland political pressure campaign. That combination matters, not because it's dramatic, but because it changes who has to hedge, who has to rebalance, and who suddenly can't afford to be wrong. And if you stick with me, I'm going to give you the one hidden detail that explains why the dollar can weaken even when everyone else screaming risk off. Oh, plus the exact levels and tells to watch this week and what breaks if the market flips the other way. Because if this one level snaps, the math changes. Let's ground this in where the dollar actually is. Coming into the open, the DXY has been hovering around the 99 handle, with recent chatter putting it near roughly 99. 2, as trade tension headlines leaned on the greenback. The number itself isn't magic, but the zone is. The 99s versus 100 plus isn't a T, just a psychological line for retail charts. It's a systematic line for risk managers, vol sellers, and anyone who's been treating the dollar as default safety. When DXY can't reclaim 100 cleanly, it tells you the market is charging a different kind of premium. Not growth is strong, not rates are high, but policy risk and confidence risk are rising. And that's where the real pressure starts. Now zoom out one notch. DXY is not the dollar versus the world. It's a specific basket, with Europe doing a lot of the steering. So if the euro catches a bid, DXY can look soft, even if the dollar's mixed elsewhere. That's why you can't be lazy with the narrative. You'll see one headline and think, dollar down because risk on, and then you'll look at equities and realize they're down too. You'll see gold ripping and think, panic, then you'll see yields not exploding, and it won't add up. Good. That confusion is actually a signal, because the hidden detail is this. The dollar can weaken during a risk-off pulse if the market stops treating the US as the cleanest shirt in the hamper and starts treating it as the source of the volatility. That's not conspiracy, that's incentives, that's portfolio behavior. And it has been popping up in real commentary from institutional managers who openly talk about trimming dollar exposure when policy becomes erratic and the most rules feel unstable. This is the part mainstream coverage misses because it's uncomfortable. In classic risk-off, the dollar usually gets a reflex bid. People sell equities, they buy dollars, they buy treasuries. They crowd the same safety door. But when the risk event is US-generated, tariff threats, governance uncertainty, abrupt policy swings, the safety door can shift. The bid can migrate into the Swiss franc, into certain parts of the curve, into gold, into cash that's not necessarily USD heavy. And you get that strange tape where the fear assets rise, yet the dollar doesn't lead the parade. That's the market quietly repricing institutional trust. And the next detail is what flips the whole setup. Because the open is not a timestamp, it's a process. The first hour is a battle between three forces. Futures that traded while you were asleep, cash flows that were waiting for the bell, and hedges that must be reset when liquidity returns. Yesterday, the US cash market was closed for the holiday, but the world didn't stop. Futures and FX kept moving. Europe priced the shock, and now US cash has to reconcile that information in real time. That's why opens after holidays can feel like a trap door. Liquidity comes back in layers, not all at once, and that creates pockets where price can jump, reverse, and jump again. But that's not randomness, that's structure. Here's how it works in plain English. When markets are thin, it doesn't take a lot of flow to move price. Then when liquidity returns, the first wave is often hedging, not fresh conviction. Dealers and market makers re-square, funds rebalance, corporates roll hedges. And if the dollar is soft into that process, it changes the hedging map. Because a softer DXY is, mechanically, a tailwind for anything priced in dollars and a headwind for anyone who is short dollar risk without meaning to be. And a lot of people are short dollar risk without meaning to be. That's where the pressure shows up first. Now let's talk about the headline everyone will blame. The clean story is tariffs and geopolitics. Specifically, threats of tariffs against multiple European countries, tied to a political push over Greenland. If you watched markets yesterday, you saw the mood. European stocks leaned lower, risk got cautious, and safe haven assets jumped. Reports even had gold and silver printing fresh record highs in the scramble for protection. And you know what? Headlines like that matter. They change expected trade flows, they change growth expectations, they change corporate planning. But the real market impact isn't just fear. It's the forced behavior that comes after fear. Because tariffs aren't just a tax, they're a volatility machine. They raise the probability distribution of outcomes. And volatility is what forces hedging. That's the part that matters. When volatility rises, options become expensive, hedges get adjusted, and the market can start moving because hedges are moving, not because fundamentals changed on the minute. This is where we have to get technical for a second, but I'll keep it clean. Dealers who sell options hedge dynamically. If the market moves, their hedge needs to change. In certain price zones, usually around big round numbers like 100 on DXY, options positioning can be dense. When price approaches those zones, the gamma effect can turn small movements into bigger movements because the hedging demand accelerates. If you're not used to thinking that way, here too as the translation. Sometimes price moves because someone is forced to chase it with a hedge. Not because they want to, because they have to. So what does a softer DXY mean at the open? It means the market is testing whether the 100 handle can reassert itself as a ceiling or flip back into a floor. If DXY opens soft and fails to reclaim 99, 7 to 100 quickly, it invites the next wave. Systematic trend models get more comfortable staying short, vol sellers get more cautious about selling dollars, and global allocators feel less urgency to keep everything hedged back into USD. That's the reflexivity loop. And it doesn't need a dramatic catalyst to keep running once it starts. But that's not the part that matters. The part that matters is what it does to the complex, metals, commodities, and the paper versus physical tension that metals people obsess over. A softer dollar has a textbook relationship with gold. It reduces the headwind for non-US buyers and often supports bullion in dollar terms. But the deeper relationship is positioning and credibility. When policy headlines raise institutional stress, gold doesn't just trade as inflation, it trades as governance insurance. And that's why you can see a day where equities fall, gold rises, and the dollar doesn't rip higher, because the market is buying insurance against US and centered volatility rather than fleeing into the US itself. That's a different regime. It's subtle, but it changes how you should read the tape this week. And if you're in the metals crowd, you already know this. Futures can print a price that looks orderly while physical markets whisper something uglier. Premiums, availability, delivery urgency, and real-world sourcing don't always show up in the front-month candle. You can have paper calm with physical tightness, and the bridge between them is spread behavior and delivery window dynamics. Even without throwing a bunch of inventory numbers at you, you can watch the tells. Do nearby contracts stay sticky? Do spreads firm when price dips? Do dips get bought fast while the dollar is soft? That's how you know it's not just a headline spike, and that's where the real pressure starts. Now, we stack the evidence because you don't build trust with one argument. You build it by showing that multiple independent signals point in the same direction. Proof point 1 is the narrative mismatch. Risk sentiment shaky, yet the dollar doesn't behave like the undisputed refuge. That's a regime clue. Proof point 2 is the relative move in major pairs. Reports had the euro and pound gaining roughly a few tenths against the dollar on the tariff shock day, which is exactly the Sell America Fears footprint. Money choosing alternatives inside developed markets rather than crowding into USD. Proof point 3 is the safe haven substitution. When the Swiss franc catches a bid alongside gold, it tells you the market is diversifying safety, not just buying dollars. Proof point 4 is rates behavior. Commentary indicated bond yields were in T, exploding higher even as the dollar softened, which suggests the move isn't simply higher US yields not requiring stronger dollar logic. It's risk premium and flow. Proof point 5 is positioning. Public data series tracking reportable positioning in dollar index futures have shown meaningful swings, and recent readings suggested a reduction from prior elevated levels. Less everybody long dollars, more people lightening up, which makes it easier for DXY to stay heavy on bad headlines. Different signals, same story. The dollar is being treated less like default and more like exposure. Now, before you get carried away, we have to talk about the counterpoint. Because a softer DXY does not mean the dollar is done. The dollar is the funding currency for global stress, whether people like it or not. In a real liquidation, dollars can become scarce and the USD can spike violently even if the longer-term story is bearish. That's not a contradiction. That's the market's plumbing. When leverage unwinds, people need dollars to meet margin, settle trades, and cover short-term obligations. So the dollar can rip up on a bad day even if the macro regime is drifting towards softness. That is why the open matters so much. You're ever watching which force is dominant right now. Risk premium and confidence reprice, or funding squeeze and forced USD demand. And the next detail is what flips the whole setup. Here's the best way to tell the difference without drowning in indicators. Watch how DXY behaves when equities wobble in the first hour. If stocks are red and VIXY behavior appears, and yet DXY can't catch a bid, that's the Sell America Risk Premium signature. If stocks are red and DXY rips higher at the same time, that's the funding squeeze signature. Then cross-check with gold. In the risk premium regime, gold holds up or climbs even as equities weaken because the market is buying insurance. In the funding squeeze regime, gold can actually dip initially as people sell what they can to raise cash, even if it rebounds later. That cross-check is huge. It keeps you from getting emotionally whiplashed by one chart. Speaking of emotions, let's put a shield on your brain right now because the market is going to try to manipulate you with speed. The fastest way the market transfers position from impatient hands to prepared hands is volatility. You will see a headline. Price will spike. You'll feel urgency. Then you'll see a reversal that makes you feel stupid. That's not personal. That's how liquidity hunts work. If you're not careful, you'll start chasing candles like you're paying a toll to the market. Don't. Your edge isn't prediction. Your edge is process. Separate trend signal from noise? Trend signal is a level breaking and holding with follow-through across related markets. Noise is a spike that dies the moment liquidity returns. So let's translate softer DXY at the open into concrete behavior, the stuff you can actually watch. First, it loosens financial conditions for dollar-priced commodities on the margin. That doesn't mean oil or copper will moon instantly. It means the headwind is reduced and it takes less positive news to keep them supported. Second, it supports precious metals not only through FX translation, but through that credibility channel we talked about. Third, it can give emerging markets a little breathing room, unless the tariff story hits growth so hard it overrides the currency relief. Fourth, it changes hedging behavior for global investors who own U.S. assets. A softer dollar can reduce the pain of hedging costs for some, but if the dollar becomes volatile, the hedging decision becomes urgent again. That creates flow. Flow creates price. And that's where the real pressure starts. Now, the calendar trigger. Why now? Why today? Because we're in a rare overlap window, a post-holiday liquidity return, a major global summit week in Davos, and a policy headline that explicitly threatens future action starting February 1st, with talk of escalation later in the year. That creates a timeline. Markets are forward-looking, but they're also deadline-driven. When you give the market a date, you give it a reason to pre-position, to price probabilities, and to hedge tails. The week of a big summit also matters because it's when politicians try to shape narratives and narratives shape volatility. Even if nothing official happens, the drip of remarks can force desks to reduce risk. And month-end gravity is already creeping in the background. Allocators start thinking about rebalancing as the calendar turns, especially if there's been a strong move in one direction. That's why this open isn't just another open, it's an intersection. Let's get specific about levels without pretending we have a crystal ball. On DXY, the magnet level is 100. Above it, the market can start to behave like dollar stabilizing, which can cool commodities and slow metals temporarily. Below it, especially if the index fails to reclaim the high 99s, you increase the probability of a test down toward the lower end of the recent range. High 98s potentially, even the 98 area that some outlook pieces referenced earlier in January. Those aren't targets. They're zones where behavior changes. That's the key distinction. Levels matter because they're where the crowd is forced to make a decision. Now plug that into metals because that's your audience. If DXY stays soft and gold is holding elevated levels after those record high prints reported in the tariff shock, the key question becomes, does gold give back gains when the dollar bounces, or does it shrug off a dollar bounce and stay bid? If gold can stay firm even on a modest dollar rebound, that's strength. That means the bid is not purely FX translation, it's insurance demand. And if silver is keeping pace, especially after reports of it surging to extreme highs, that's a different animal. Silver is the metal that exposes liquidity games because it's smaller and it gets pushed around harder. If silver holds gains through a choppy dollar, it tells you the market is comfortable, wearing risk in real assets. If silver gets smacked on the first hint of funding stress, it tells you liquidity is still the boss. The next detail is what flips the whole setup. Now let's talk about the institutional flow angle because it's the quiet driver that retail tends to ignore. When large asset managers say they're scaling back dollar exposure, that's not a soundbite. That's a flow decision with hedging consequences. If a big European investor trims US assets or increases hedging on them, that can create selling pressure on the dollar or reduce structural demand. And if political headlines cause certain sovereign or institutional pools to reduce US allocations, even at the margin, it can shift the equilibrium. These are not day trading flows, they're slow-moving tectonics. But when those tectonics line up with a headline shock and a liquidity transition day, you can see the surface move faster than people expect. And you can see it in the plumbing too. The true stress signal isn't always spot FX, it's dollar funding. How expensive it is to source dollars through swaps and cross-currency basis. When global investors want US yield but hedging costs rise, or liquidity gets weird, they change behavior. That can reduce demand for dollars, or it can create episodic surges when hedges get rolled under pressure. You don't need to be a basis trader to respect this. Just remember the translation. The dollar's value isn't only about rates, it's about balance sheet capacity. When balance sheets are cautious, markets gap more. And gaps are where people lose discipline. Don't give them that. So what comes next? Here's your two-scenario lens for the next week or two, the part that keeps you credible and keeps you sane. Scenario 1 is the controlled pullback and retest. In this path, DXY stays heavy, but not collapsing. It chops, maybe reclaims part of the move intraday, but fails to build above the 100 zone. Metals and real assets cool off a bit, maybe retest support, but the bid underneath them remains. Volatility spikes are sold back down, not because risk is gone, but because the market is comfortable carrying the hedge. In this scenario, the trend signal is intact, even though the tape looks messy. The confirmation would be DXY making lower highs, euro and pound holding gains, gold refusing to give back more than a modest portion of its spike, and equities stabilizing without a dollar surge. Scenario 2 is the continuation squeeze and gap risk. In this path, the dollar weakness becomes self-feeding because 99 becomes an air pocket, and the market starts pricing a larger confidence premium. The DXY fails early, slides, and every tiny rebound gets sold. Real assets don't just hold, they extend because the market starts to think the next policy headline could be worse, not better. Volatility rises, but not in a straight line. It becomes a whip. In this scenario, the risk is not that you're wrong about direction. The risk is that the path is violent. You can be right and still get wrecked by timing. Confirmation here would be DXY cannot reclaim the high 99s, even on risk-off headlines. Gold makes new highs and holds them. Safe haven alternatives like CHF stay strong, and equities can't stabilize without real policy relief. And that's where the real pressure starts. Now, what invalidates the softer dollar thesis in the near term? One thing, a classic funding squeeze. If something breaks in liquidity, credit spreads jump, equities gap down hard, and you see the unmistakable signature of forced deleveraging, then the dollar can spike because everybody needs it at the same time. Invalidation isn't DXY ticks up. Invalidation is a sustained bid where DXY reclaims 100 cleanly and holds it while risk assets are under pressure. That combination tells you the dollar is back in charge as the world's margin call currency, at least temporarily. And if that happens, metals can get hit in the short run, even if the longer-term narrative still supports them. That's why risk framing isn't optional, it's survival. So let's turn this into an open checklist you can actually use today without overthinking. First tell, the first 15-30 minutes, does DXY bounce and immediately get sold? Or does it bounce and attract follow-through? Second tell, what do yields do when equities wobble? Do yields stay stable and the dollar stays soft? Or do you get that reflex dollar up pulse? Third tell, gold. Does it hold firm through equity weakness? Or does it dip as cash demand rises? Fourth tell, the FX leaders, are USD and GBP/USD holding their recovery zones or fading instantly back? And fifth tell, spreads and speed. Does the market move in smooth increments or in jumps? Smooth suggests normal repricing. Jumps suggest hedging and thin liquidity traps. If you want one simple rule to protect yourself emotionally, do not confuse volatility with information. Volatility is often a weapon. Headlines will be timed to maximum emotional impact. The tape will be pushed into obvious stops. You will be shown a 5-minute candle that looks like it's over. Then you'll be shown the next candle that looks like it's back. That's the market checking who's reactive. The way you win is you decide what matters before the open. You decide your levels. You decide your invalidation. Then you watch whether the market respects those levels. Everything else is noise. And here's the final hidden detail to lock in. The one metric most people will not track, even though it explains the whole setup, how the dollar behaves when it says supposed to act like safety. That's the tell. If the dollar can't do its job on a day when fear is everywhere, it means the market is questioning something deeper than growth. It means the market is charging a credibility premium. And that's why a softer DXY at the open is not just a currency story. It's a regime story. It's the market voting on trust with price. So today, don't just watch the DXY print. Watch the reaction. Watch the hold. Watch whether 99 acts like a trap door or a springboard. Watch whether 100 becomes a ceiling the market can't reclaim, or a floor it snaps back above. And keep your two scenarios in your pocket so you don't need to get hypnotized by the candle of the moment. Controlled pullback and retest is healthy for trends. Continuation squeeze is profitable but dangerous. A funding squeeze is the surprise villain that can flip everything fast. If you can separate those paths, you stop being the liquidity that other people feed on. And if this is the kind of breakdown you want more of, the kind that treats you like an adult, gives you mechanisms, gives you invalidations, and doesn't just sugarcoat the volatility, then stay in this corner of the internet with the people who actually respect market structure. because the next 2 weeks are going to be about deadlines, hedges, and who gets caught leaning. And when the dollar can't hide the story anymore, you'll already know what to watch.